Hi, welcome to Trading Edge 360. We are going to talk about outlook for the hot markets in 2025, gold, crypto, and AI stocks. This will be presented by Lachlan Meakin, the head of research of Gold Markets, which is our partner broker. Please take it away, Lachlan.
Hi, V. Thank you for having me. Hello, everyone. I'll just share my screen. One moment. All right. Yes, hi, everyone. We're just going through, from a broker point of view, the hot markets of 2025. So these are the markets we've seen a lot of volume in, a lot of trading, a lot of money made, and sometimes unfortunately lost. But go through some of the macro reasons of why these markets are the hot markets of 2025. Have a look at a few charts and just go through some of the background of what's driving these markets. Okay, I just need to quickly do a quick disclaimer. It's obviously general advice, not taking your personal needs into account here. So everyone knows, do their due diligence and take this as educational material. Just a quick background on Go Markets. We were one of the first, or the first Australian Forex broker to bring the MetaTrader platform to Australia. We've officially got our AFSL in 2004, so over 20 years ago now. One of the longest, the oldest brokers in Australia. So we've been we have access to over 2,000 assets, CFDs, Forex indices, shares, commodities, cryptocurrencies, anything you want to trade, pretty much you can with us. Tight spreads, very good support, and obviously the best research and account managers in the business, if I do say so myself. Okay, so what I'm going to concentrate on today, the markets, as I said, we've seen the most interested in and the most volatility and the most opportunities in this year have been cryptocurrencies, Bitcoin in particular, which I'll be focusing on mainly. Gold, seen all-time highs, a lot of volume in gold, one of our pretty much our biggest market at the moment we're seeing trading in. AI-related stocks, it is the kind of the hype, the buzzword of the year. It's worth having a look at those, and they've also been very popular and performed very well this year. So some of the overall macro themes we have seen in 2025, obviously a new US president who's been a little bit disruptive, if you could say, with and unconventional with tariffs, a certain America First policy, which has caused consternation among the allies with trade, etc. Conflicts in the Middle East and Ukraine, unfortunately, still going on, which sees safe haven flows head to some of these markets such as gold and even Bitcoin these days. Market risk, markets a little bit more fragile maybe than they seem. There's always that fear that we could have this sell-off coming at some stage. Inflation seems a little bit sticky. We've seen some good figures lately, but there's also been some bad ones as well. We've seen that the US just this week with a CPI that was okay, but then a PPI that came in hot. So that inflation story is still hanging around, and obviously ongoing central bank actions. So from the rate cutting we had during COVID, so the rate hiking after to stop inflation, and now we're seeing that cycle go back to the cutting stage. All right, we'll start with Bitcoin. Very exciting market this year. Obviously seen all-time highs, and we're near those all-time highs right now. So obviously it's the most popular and highly traded of the cryptocurrencies. Very big year in 2024, up over 100%, breaking new ground, getting past that very big psychological level of 100,000 US a token. 2025 saw a bit of a rocky start. I think the market was quite optimistic with Trump coming in. He was quite crypto friendly, and we're pricing in him being a little bit more friendly than maybe he was at the start. So we did see a drop at the start of 2025, but that upward momentum has certainly re-established itself now. We've seen all-time highs in the last couple of weeks of over 120,000 a coin, which is up 20% year to date so far. Now, just a quick look at the chart. I'll be using TradingView charts. There will be an offer at the end about TradingView. We'll get to that. But the charting on TradingView I find is excellent, but we'll go through a few of those features and as we go in this presentation. So we see Bitcoin 2024, a little bit choppy, a real surge at the end literally as Trump's odds started going up for the election. The crypto bulls were pricing in a very friendly administration. We saw the start of 2025 and the actual inauguration, and we had a sell-off where I think it's always that buy the rumor, sell the news, but they have kind of proven themselves to be a very friendly, crypto-friendly administration. So we've seen that upward momentum reestablish, and yes, just recently hitting these highs around 125 K per coin. And one thing about Bitcoin is some of these big levels, you can see the 100,000, and we're now sitting at this 120. The big round numbers, the psychological levels, really do play a part in price action on this crypto. All right, so let's look at some of the macro reasons why Bitcoin has been a hot market in 2025. So certainly seen some real increase or soaring institutional demand and ETF inflows. Momentum behind Bitcoin this year has largely been fueled by this institutional adoption. So the figures of over 50 billion in new inflows have poured into Bitcoin ETFs. BlackRock being a large one, and very established financial behemoth. So if they're getting involved in Bitcoin, it really adds that, I guess, that maturity factor to cryptos now. So crypto-friendly US policy landscape, which was discussed before. We saw that pricing in of a very friendly administration to crypto. Now we've seen some major policy shifts under the Trump administration. So we've got the 401k and retirement funds like the Australian super funds able to include crypto investments. Also creating a strategic Bitcoin reserve and a lot of broad deregulation as well. There's seen some court cases, etc., against parts of the crypto industry being dropped since Trump took over. Favorable macroeconomic conditions. So there's several drivers that's bolstering Bitcoin's appeal there. Market expectations for Federal Reserve rate cuts, which is weighing on the US dollar, and rising inflation. So that kind of brings that stagflation story into the forefront, which we'll see some of these safe havens, which Bitcoin's seen almost as one now with digital gold, I guess, in a way. And also, with those rate cuts, they'd expect that the markets will go up and the risk will be back on, which is another reason for, supporting of Bitcoin there. Increasing integration of financial markets. So no longer a fringe asset. A few years ago, Bitcoin was, just for Bitcoin bros who are buying dodgy things on Pirate Bay, on Silk Road, whatever. But it's really matured as a financial instrument. We've seen this institutional adoption, etc. So when you look at the correlations with stock markets now, I mean, especially the Nasdaq, it almost trades like a Nasdaq stock Bitcoin. If the Nasdaq's up big, it's very, very likely that Bitcoin's also up for that session. So with that correlation, it kind of signals maturation and making Bitcoin more relevant for portfolio strategies where you like to hedge and diversify. An interesting chart here. So we look back at really when Bitcoin started taking off, which was, I guess, around 2020, when it went from a kind of a fringe asset to that first quite big move up. There was one in 2017 as well, I think, but this was the main one, I think, at the start of it. And every time we've seen these real blow off tops in Bitcoin when it was a little bit less mature, we saw these big drops straight after. Now this is the FOMO of the traders getting into these big moves, and unfortunately we'd see these big drops. So we saw 55 back in 2021. The next big high it made, another 50% drop, and really in the doldrums for a couple of years. We're seeing this big push up just the start of this year now, and this is where it's taken out this very big level of 100,000. Now the drop, the start of the year was after Trump's inauguration. There was looking like it was going to repeat what it had done before, with these blow off tops, drop 50%, which would have brought it down to around 50,000. But the strength, I think the extra support of the maturity of what in those last couple of years saw it hold this very big level of 70,000, which had been a big resistance level in the past. And we've gone past that 100,000, which is also a very big level. You can see that it's pushed through, supported. This is a key level where we are now, around this 120. I think it's dropped a little bit in the last couple of days. This 120 level, we certainly want to watch. The 100 has proven very good support. But if we can get through and holds this 120, the next step may is, you think that would be a base for a move higher, depending on the macro story in the background, obviously. Another crypto, this is one of the really great features of TradingView, the ability to compare one instrument against another. So this is actually Bitcoin divided by Ether, the ratio. And Ether is another, probably I would say the second biggest crypto. It has kind of been in the shadows of Bitcoin, but certainly lately taken off. So this chart really is showing Bitcoin outperforming Ether quite strongly up into May. And then we've seen it really pull back. So even though we have Bitcoin up at the highs, this would suggest that it's not overbought to an extent when you see that the other cryptos have caught up. And that's Ether rising while Bitcoin's kind of stagnated, you might say. If the idea of this is, if this was well over up here somewhere and Bitcoin was high, you would think there may be an overbought factor to it. But this normalizing a little bit this ratio could say that, okay, Bitcoin's, yes, it's had a big run, but it's actually been able to hold those highs while other cryptos have caught up, which could suggest that it's very well supported at those levels. All right, so outlook for Bitcoin for the rest of the year. So I think it's going to really hang on September. So historically, it's been a rough month for Bitcoin, only 4 of the past 12 closing green. So when you look at the seasonality, Bitcoin, September is not a good month for Bitcoin. This year is bigger than just that history, though. We set the stage for Q4 in September, which is normally the biggest bullish window for risk on assets, which Bitcoin will normally follow the risk higher if we see the stock market going up. Now, what's important mainly about September is the Fed's expected rate cut. And now with latest figures out, the CPI not being as bad as what it could have been, the markets have really priced in a very big chance of a 25 basis point cut September FOMCs. I think that's around mid-September. So when we look at the fourth quarter seasonality for Bitcoin, 85% returns in Q4 is normal. Yes, 85 returns, cementing as one of those bullish quarters versus Q1, Q3 combined. So I think technically, if they can hold that level above 120, which it's pushing up against, we get that cut, then and we see risk on back in Q4, it could set the scene for another push higher in Bitcoin. So definitely want to watch September, how that plays out for setting up for Q4. All right, so let's move on to gold. Now, obviously, a lot of things in the world have caused a surge in haven demand, trade wars. We saw gold have a really big start to the year. So to hit that $3,000 an ounce for the first time in March. We saw another big push higher to an all-time high, 3,500 in April. Now, it was just one-way traffic for gold as the tariffs came in and things around the world were seeing that safe haven flows. But it's consolidated a bit since then. It hasn't moved a lot, but it's still up over 27% year to date. So tariff concerns that with risk higher inflation, keeping it supported, economic growth concerns, obviously, geopolitical risk, and there's also some big central bank buying, especially out of China, etc., which is keeping it well supported at these levels. So not quite as exciting as the Bitcoin chart, but up 30% last year, up 27% so far this year. So it's actually outperformed Bitcoin. We haven't seen the real sell-off that Bitcoin had at the start of the year. We've seen a pretty gradual move up, and this blow off top here, 3,500 was the high. We have seen some consolidation. A lot of macro factors affecting gold that will kind of dictate, I think, where it'll go for the rest of the year, which we'll get into a couple of those now. Okay, safe haven demand. Obviously, we've got this elevated geopolitical risk, which is everyone knows will throw people to gold. There's misinformation about tariffs on the Swiss gold refiners, etc., which saw it go up and down. Obviously, the tensions with Russia and China, concerns over stagflation. This risks always drive investors towards gold, perceived safety. As we spoke before, central bank buying. There's a big increase in that, especially in Asia. China's central bank has gold purchases for the 9th consecutive month in July 2025. They can't get enough at the moment. So there has been some weaker from the Gold Council jewelry demand. It's only a small part of gold, but the institutional buying has stayed very robust. So it's really put a floor and helped it, stay at these sustained, these elevated levels up here. Now, monetary policy, currencies. So weak US dollar. We've seen the US dollar not do very well last few months. Obviously, gold being priced in US dollars always puts a tailwind under it if the US is weak, the dollar's weak. Now, bets on Federal Reserve rate cuts too. So these conditions reduce the opportunity cost for holding non-yielding gold. So the lower interest rates are, gold being non-yielding makes it more attractive because you're not getting much yield with bonds, which is one of the rivals for gold in the safe haven area. Obviously, momentum ETF flow similar to Bitcoin. There's always going to be that FOMO and momentum of anything going up that kind of feeds on itself for a while. So ETFs certainly been a big part of that. Pushed that momentum up. Investor interest obviously increased with those ETFs going in. So what they've calculated is around 5% of gold's returns in the first half of 2025, came through those ETF flows there. Another very big reason, and this is, the macros we went through there, they're the type of things that have been around for years, have always affected the gold price. But something very interesting has happened this year, which I've wanted to highlight in its own slide here, is that trust in the US dollar and treasuries has really taken a hit. So the reintroduction of these tariffs under President Trump has significantly eroded investor confidence in the US dollar and treasury markets, which are historically considered safe haven assets. So what that means is that in the past, you would see when the market drops, when those equity markets were scared or fearful, you would see the dollar normally rally, US dollar, and you would see bonds rally, and and gold as well. So they were all seen as safe havens. But since this Trump Liberation Day, there's been a bit of a loss in trust in the dollar and US bonds. So we've seen them sell off, and that's really helped gold out. That's, I would say, one of the biggest driving factors of gold breaking out this year, is that its rivals in the safe haven space have really taken a hit and seen it, take preeminence in that safe haven field. So what we saw as well is once the tariffs came in, we saw a spike in yields, which a spike in yields means a drop in bond prices. But at the same time, we saw the US dollar depreciating. So this is very unusual. And you'll see in this chart here that how closely correlated the US dollar index and yields are for interest rates. And that makes sense. But there's a real break here, and this is very unusual. These tariffs were so out of normal that we've seen yields rise and the US dollar drop. And this is a trading view chart to kind of show the relationship of yields and gold. Before, the other one was yields and US dollar. So this is inverted US 10-year yield. So when this is going up, it actually means that rates are going down. So as rates go down, gold would normally go up because it's non-yielding. If this doesn't have as much competition against the yielding assets if the rates are going lower. And then we see this break here. This is Liberation Day, where yields have dropped and then they've spiked. Well, remember, this is inverted. So if that goes down, that means the yields are spiked. Normally, gold should have gone with this line. Instead, it's broken off in a different direction. It really shows that relationship between rates, gold rates, and the dollar have really taken a hit from Trump tariffs. So if this is to normalize again, either yields will have to drop a fair bit further or gold drop to kind of match back up. But it's an interesting dynamic of what's happened since this day, this Liberation Day, where it's really supported gold. This loss of faith in some of the other safe haven assets, whether that lasts or not, we'll see. Day trading gold. I mean, for short-term gold, there's a very good range. Kind of, if you're a range trader, these are the levels to watch. You could play this range, but that 3,500 and the support level down here, which was that drop down to around 31.25 or so. This is the range to watch, I think, coming up for the near future. It's a range play if you want to trade like that, or you can wait to see what these levels do if it goes through and holds some of these as support or resistance. Another interesting chart, gold and silver ratio. This is something else you can do in trading view. Obviously, we see the kind of normal median is around that 87. There was a big push. This is gold outperforming silver. This is something, unusual for that to happen, which was obviously the tariffs around that time. We have seen since silver catch up, similar to what we saw Bitcoin and Ether. So also, I would say this is bullish for gold that this has normalized and yet gold has managed to hold near those highs. You can't, at this point here, you could have said gold was quite overbought because it's gone well outside the normal range of that ratio. But now this is normalized and gold's held on. It is a good sign if you're a gold bull. Another interesting one's gold versus copper. We see this ratio goes up when the market's fearful because gold's outperforming copper, which is an industrial metal, which obviously doesn't do well if the economy's not doing well. An interesting level we're seeing at the moment, I mean, there was a big sell-off in copper, which has seen it hit back up here, but these levels here, the COVID levels, there was obviously a black swan event. To be at the same levels there now may indicate that the market is a little bit more fearful than what you may think, that there is of an economic slowdown, and being the safe haven attraction of gold has brought this ratio right back up. How that will play into the actual price of gold, we'll wait and see. But it's going to be interesting. But it's definitely an interesting a ratio to look at because it's so extended at the moment. All right, so outlook for gold. Okay, so gold in 2025 has really benefited from a perfect storm. If you're a gold bull, you couldn't have got more good news really this year. So geopolitical uncertainty, the central bank accumulation, favorable money conditions with interest rates starting to get cut, momentum-driven investor demand as well. So it's been at the forefront of a lot of people's safe haven kind of diversification. So it's a tough one to say where the gold's going to go. There's forecasts from all the big guys, a very wide range between 3,100 and 4,000. So there is some, it just indicates a difficulty, I think, at the moment of where gold would go. There's just so many macro factors affecting it. There's really strong cases for both the bull and the bear case. So I think traders will need to be mindful of the elevated risk that this could be a plateau in gold, or it could experience a decent correction if economic optimism returns, some of these macro tailwinds fade. So yeah, gold, I think at the moment is probably a range trade until we see some of these macro factors change and some of those big levels either broken up to the upside or downside of 35 and around the 3,100 is the levels to watch, I think, going forward. Okay, so AI equities also another very popular market at the moment. AI is everywhere. It's the hype. Is it hype? Is this going to be another .com bust like we saw 25 years ago? We'll have a look at a few of the macro reasons and a few of the look under the bonnet a bit of these AI stocks. But I mean, everyone's talking AI. It's a booming industry. It's what they say is going to drive the next technology revolution. For investors, the most important question, I guess, is whether these expectations priced into the markets today project a realistic path ahead, or if it's just hype and it's driving unrealistic valuations, which we have seen in tech when there's new tech, where, as we saw in the .com bust, it can happen. All right, so a few powerful tailwinds, I think, driving the AI-related equities. So it's obviously explosive demand, big giants like NVIDIA, AMD, building these data centers, and they need chips to do that. And with the NVIDIA's data center revenue surged 69% year on year in Q1 2025, which has been a big driver of its stock price this year. It's expected to keep going as the big players start ramping up their capex as well. So bullish analysts, obviously, have upward price targets. So this kind of FOMO, this momentum from the constant bullishness and these price targets being moved up by the big analysts. So NVIDIA, AMD, Dell, Micron, booming AI server demand, for example, when NVIDIA's target has been lifted as high as 225. Currently, it's around about 180. So still a fair bit to go, according to some analysts. Similarly, Micron's strong guidance has led to upgraded outlooks and boosted investor confidence. Big tech and hedge funds doubling down. Major institutional investors we're seeing, Bridgewater, Tiger Global, significantly increase their exposure to AI with leaders NVIDIA, Microsoft, Alphabet, and Meta. And meanwhile, the Fab Four, NVIDIA, Microsoft, Meta, and Broadcom, comprise 21% of the S&P 500 and are responsible for around 60% of the gains this year. So really helping the market, anchoring the broader market bullishness. Now, this is the most important, factor with AI stocks, is that real earnings are actually backing these high valuations. So unlike pure hype bubbles of the past, .com bust, as I was mentioned before, analysts note that today's AI rallies are grounded in revenue growth and profitability. Even so, there are the warnings of overheating. We did see some big drops earlier this year in some of these stocks before they regain their upward momentum. So always a bit of caution with them, but excessive valuations, some AI names could spark corrections. Now, just a few charts to go through that last point there, the hype versus the reality is, if we look at this chart from, again, that last 20 or so years, 1999, obviously this is the .com bust, where the top 10, or the tech stocks in the S&P 500 outperformed the other 490 by a mile. Then we see the bust, it's back to normal for many years, and we see that separation again. Now, is this going to be another one of these? Well, if we look at a bit more information on that, maybe not. So we're going back to the .com bust. Cisco was the darling of that rally. We see the price of the stock because compared to its 12-month price to earnings per share. It went way above. There was a real speculation bubble there. Obviously, we had the bust, and it's back down to a more realistic price level compared to its earnings. But if we look at NVIDIA, which is the new darling of tech stocks, it's a very different story. Even though we've seen this massive price rise, we've also seen a very big rise in revenue. So this would suggest that this time it may be different. It's not the same speculative, crazy bubble we saw back in 2000 with the .com bust. The actual valuations and earnings of these companies do seem to support their price moves they've had. So an outlook for AI stocks. Look, AI is not going anywhere. Market expansion estimated at 638 billion in 2025, projected growth of nearly 3.7 trillion 10 years. So AI sector continues to lead markets. The important thing is it seems to be backed by real earnings and structural demand from data centers and enterprise adoption. The AI-driven optimism definitely is the story of one of the big stories of 2025, and I suggest it will continue. Some of the takeaways for traders on these, I guess, investors, if you want to get exposure to the AI market, obviously do your due diligence. It is a volatile sector, but sticking with more established names like Nvidia, Microsoft for the core exposure, and considering, I guess, the high growth yet riskier players like Micron and CoreWeave to balance that portfolio is probably an option. But saying that, it's a very bullish sector, but it's a new sector, and it's one of those ones where you will need to do a little bit of due diligence, and don't make sure that you're comfortable with the risk and the exposure you've got in some of these stocks, and also avoid limiting exposure to ultra high valuation names. So there will be a few stocks in this sector that have that speculative bubble feel to them, like the get rich quick ones that people are looking at. That I would suggest that very good idea to do a bit of due diligence on some of those and make sure that that PE ratio is realistic. That is it for me. I will have a quick look at some stocks. I just want to show people some stuff with TradingView that's really cool that I didn't put in there. So I've got a couple of minutes left before I can take questions. Nvidia stock, we've seen a real bit of a chop this year and then just taking off. So, I mean, that uptrend's very well established. It's difficult to get in front of that as a short, I would think, but possibly wait for a pullback to jump in this. But the strength of Nvidia is amazing at the moment. And a kind of an interesting thing you can do too with TradingView is you can see how, say, Nvidia is doing against Microsoft by doing the ratio, like I showed with the gold, silver, etc. This kind of helps you look at which ones are the strong ones. Who do we go with? Meta? Do we go with Nvidia? Do we go Microsoft? So it's a good way of actually having a quick look by comparing these stocks, and it also opens up to a pairs trade as well if you want to buy one and sell the other. But I like to use it just to see which one is outperforming the other. Obviously, the stronger one.
Sorry,
Yeah.
Lachlan, you're not showing the chart.
Oh, sorry. What are you? Sorry, mate. I haven't changed the. All right, sorry, mate. I forgot I had to do that. All right, can you see that one? The chart now?
Yes.
Yeah. Sorry, guys. Yeah. So what I was going through with TradingView here is that you can compare two markets together. That's got the ability. So if we look at Microsoft versus Meta, for instance, we can see the first named one means that if that's going down, Microsoft's underperforming Meta. But I probably run out of time. I'll let we do have a promotion where we can, for all Go Markets clients, if you're an existing client or you want to join up as a new client, we have codes to give out for free TradingView subscriptions, a paid subscription for 3 months you'll have for free, so you can play around with this amazing charting package. We have actually got TradingView integrated into our platforms for trading as well now. But if anyone would like to hit me up for one of those codes, feel free. You can email me on lachlanm@gomarkets.com. I don't know if you can put that in the comments or something, V, for me. But anyway, that's it. If there's any questions, feel free.
Yes, the comments about the 3-month free subscription is in the chat. So
Thank you. Yes, anyone with an existing account, that's fine, or anyone who wants to sign up, open an account, no funding needed, no trading requirements. Just email me and I'll send you a code.
Okay, cool. Yeah. So with that code, we can just use the web-based software, right? That's it, right?
Yeah. So rather than the free plan, which has ads and things pop up all over the shop, This will
Yeah.
be a paid subscription for 3 months.
Oh, excellent.
Yeah, so
So
no ads and yeah,
I
more
will get a
features.
quote from you too.
No problem.
Yeah. Okay. So we are into the Q&A and there's a question. I'm not sure. It's do you think Bitcoin may drop below 100K in 2025?
I personally don't think it will. I think that 100K has proven to be a very strong support level. It's a very big level. It possibly could see some ranging between 100 and 120, but yeah, I think, as I said, September is a big month. If we can see it could break through that 120 and hold it, it could set a base for another move higher. But I think, personally, I think 100 is a very, very strong support. No, unless something drastically changed, I can't see it going below that this year anyway.
Okay, cool. I agree with that. It's a bit difficult to, I think a lot of people want to buy it below 100K. I don't think it's
I
likely.
know, I know. It's hard to buy at the high levels. I know.
A lot of institutional investors and also a lot of initiatives from the US government now to develop the crypto sector. So it's a
Yes.
little bit hard. Um, okay, what's your view on Ether? Is it a slow blockchain with lots of competition but having institutional demand?
I think there's a very good bull case for Ether as well. I think it did lag behind Bitcoin, but you can see it's really taken off. And when I showed that ratio before as well. You can see Ether's absolutely been smashing Bitcoin lately. So yeah, it's the adoption of, I think Ether is a very strong crypto play as well. Ether and Bitcoin probably the two that I would personally invest in because of the more the institutional backing of them. The other ones like Ripple and things like that, Monero, I think they're more short-term speculative plays, but I think Ether and Bitcoin certainly are the ones that more an investor and more of a long-term approach, I think.
Yep, certainly agree with that. Also, as the question comes with a lot of institutional demand. Yes, we are seeing a copycats of the Bitcoin treasury with now Ether being their focus now,
Yeah.
issuing bonds to buy Ether. So that's going to drive markets, drive Ether prices higher, I think, in the longer term. So a question about gold markets. You said that there's two, uh, is Mauritius and Australia. Then which one should I sign up for?
When you go to gomarkets.com, it'll take you to the relevant license. So Mauritius is our main offshore license for everyone outside of Australia. Um, Australians would sign up under ASIC, but everyone else under Mauritius, basically. But
Okay, cool.
when you go to gomarkets.com, it'll take you to the correct website. You don't need to specifically go to different ones.
Right, cool. And if you want the promotional offer, you can just track us down. Maybe Sue can give the track record promotional offer for Go Markets. You can sign up there. I guess that's it for the session. Oh, one more question just popped in. How will the US tariffs affect gold, Bitcoin, Ethereum moving forward?
Well, what tariffs? The thing is with Trump, they call him Taco. Trump always chickens out. So it depends how hard he pushes them, whether it's just part of a deal, part of a, like a bait and switch, who knows? But what it causes is uncertainty. So certainly benefits gold. I think it's a safe haven. For cryptos, what you want to see is risk on. So you want the tariffs to be less bad than expected, I guess. You want to see the Nasdaq up. Crypto, Bitcoin especially, will follow the Nasdaq. I mean, the correlation showed before was almost 90%. So it really depends on what Trump does. If they're worse than expected, probably help gold. If they're better than expected, it'll help Bitcoin more, I'd say, as a risk on asset.
Okay, so I think that wraps it up. On the question about US tariffs, I think uh, Lachlan is absolutely right. I think it depends on whether risk on or risk off. But what you've seen so far is uh, Trump has been threatening much higher tariffs, and then he goes and make a deal. So the markets dips, and then the markets rallies when he creates the bad news, and then he provides the good news.
Yeah, yeah,
But
absolutely.
but what you've seen is that the underlying conditions for risk assets, meaning stocks, cryptos, and other relevant risk assets, is for much higher prices. And we are likely going to see conditions improve, given the Fed is likely to start cutting rates at some point, most likely next month. So if inflation continues to be moderate and the job markets continue to be slightly weaker on the against expectations, we will see higher prices for risk assets. Okay, with that we conclude the presentation. Thank you, Lachlan, for the presentation and for your thoughts, and also for the great Trading View 3-month subscription. I've been considering signing up myself, but I thought,
No,
maybe I'll do it next week.
I'll
So
send you one, mate. I'll send you one.
yeah,
Yeah.
it's very timely, very
Thank
timely.
you.
I almost caved and signed up already, but
Yeah.
it's great. It's a very good service. It's very useful for those who are not using it yet. I think the subscription comes with much more benefits. So do take advantage of the offer. The link has been it's there in your chat here. But okay, thank you.
Thanks,
We'll
Fee.
take
Thank you,
a
everyone.
Yeah, thank you. That's going to be a 10-minute break, and we'll start again in 9 minutes from now. Thank you.